Let me ask you a question that might make you uncomfortable. If you're still working and grinding towards retirement, do you actually know how much you need to save? Not the number on your 401k calculator, not some percentage of your current salary, but the real number, the number that accounts for the fact that the cost of living your life has fundamentally changed since the turn of the century. And if you're already retired or close to it, do you know whether your plan is actually working? Or are you making decisions based on a measuring stick that doesn't measure the same thing it used to? Here's what I mean. Let me put one number on the screen that changes everything. $100 in the year 2000 now requires approximately $185 to buy the same goods and services. Now that's not theory, that's the Bureau of Labor Statistics data. An 85% cumulative increase in the cost of living over 25 years. But here's where it gets interesting and where most people get blindsided. That's the average, and nobody lives in the average. If you're paying for housing, healthcare, college tuition, or professional services, your personal inflation rate has been significantly higher than the official CPI. In some categories, we're not talking about 88%. We're talking about 200, 300, even 400% increases in the cost of the things that actually matter to your life. Your retirement plan isn't failing because you're bad at math. It's failing because the measuring stick keeps changing and nobody's told you. So today, we're going to walk you through what's actually happened to purchasing power, wages, housing costs, and education over the last 25 years. And then we're going to connect all of that to what it means for your plan. So whether you're 35 and accumulating or 65 and distributing. Because here's the truth most people don't want to say out loud. The measuring stick has changed. And if your plan doesn't account for that, you're not planning, you're hoping. Let's start with the foundation. What has happened to the purchasing power of the dollar since the year 2000? Your dollar today buys about 54% of what it bought in the year 2000. The average annual inflation rate has been about 2.5%, which sounds manageable. But that average masks categories where inflation has been far worse. In 2000, the median home price in the United States was approximately $165,000. In 2025, it was around $420,000. That's a 155% increase, more than double the rate of general inflation. But it gets worse when you adjust it for your income. In 2000, the median home price was about 3.5 times your median household income. Today, it's approximately 5 times your median income. In the year 2000, your parents bought a house. In 2025, you were competing for the privilege to overpay for that same house. Between 2000 and 2025, average college tuition and fees increased approximately 150%. Now check this out. In the year 2000, the average cost of tuition and fees at a 4-year public university in-state was about $3,500. In 2025, it was approximately $11,500 to $12,000. At private universities, it went from roughly $16,000 to $45,000. Your parents worked a summer job to pay for college. You'll be working for a decade to pay off loans. Your personal inflation rate depends on what you actually spend money on. And for most high net worth individuals and households, and for most retirees, the things you spend money on have inflated significantly faster than the official CPI. The government says inflation is 2%. Your grocery bill, your insurance premium, your kids' tuition all laugh at that number. Housing, healthcare, education, professional services, insurance, quality of food, travel, these categories have all experienced above average inflation. Meanwhile, categories like electronics and apparel have experienced deflation or low inflation. But you're not retiring on iPhones and t-shirts. In the year 2000, the median household income was approximately $71,000 adjusted for inflation. In 2025, just 15 years later, the median household income was $70,000, essentially unchanged. America worked harder for 15 years and got paid the same. Meanwhile, everything else got more expensive. Well, the good news is that from 2015 to 2024, the median household income has grown. In 2024, almost $84,000. Here's the math that matters. Median income is up 18%. Median home prices are up 155%. The ratio of home price to income has gone from 3.5 times to 5 times. So let me get this straight. Your parents saved 3 years of income to buy a house. You need to save 5. That's not a housing crisis. That's generational theft. Since 2000, the United States has experienced 3 major economic disruptions. The dot-com recession in 2000, the Great Recession in 2007 to 2009, we saw unemployment peak at 10% and markets fell 60%. During the pandemic in 2020, unemployment spiked to 15% and the markets dropped 34% in 1 month. So the market doesn't care about your retirement date. Plan like chaos is coming because it always does. And for retirees, the year 2000 to 2010, that decade is a perfect case study in why sequence of returns matter. If you retired in the year 2000, you got a front row seat to the worst decade in market history. Your plan either survived it or you're still recovering. If you retired in January of 2000 with $1 million portfolio, taking 4% withdrawals, you experienced 2 massive bear markets in 1 decade. Your portfolio would have been severely damaged. Not because of 4%, and 4% is not a bad withdrawal rate, but because you took withdrawals during 2 crashes. Retiring in the bear market isn't bad luck. It's a planning failure if you weren't ready for it. So we've covered the data. Purchasing power has declined 46% since the year 2000. Housing, education, healthcare costs have exploded. Income stagnated over 15 years. The economy experienced 3 major shocks. Now the question is, what does this mean for how you plan? For accumulators, you need to save more than you think. Most retirement calculators assume the following, that inflation will be 2 to 3% annually. Your personal spending will inflate at the general CPI rate. Income will keep pace with inflation. Retirement calculators assume a world that hasn't existed since 2000. That's why everyone's shortfall comes as a surprise. But we've just shown that personal inflation rates are often 3.5 to 4%. Housing, healthcare, education inflate faster than wages. Income stagnation is a real risk. So if traditional advice says save 15% of your income, you probably need to save 18 to 20%. If traditional advice says you need 1.5 million to retire, you probably need 2 million plus. The retirement savings target you're chasing was designed for a world where houses cost 3 times your income and college was $3,500. That world is gone. So here's some rules for you accumulators. Number 1, save aggressively. Compounding works, but only if you're putting enough in. Number 2, avoid lifestyle inflation. Just because your income goes up doesn't mean your fixed costs should. Number 3, stress test for unemployment. Can your plan survive 6 months without income? A 6-month emergency fund isn't paranoia. It's the difference between a setback and a catastrophe. For retirees and near retirees, you need a distribution plan, not just an investment plan. Most retirees don't have an investment problem, they have a distribution problem. And most advisors are still solving for the wrong one. You've spent 30 years focusing on accumulation, saving, investing, growing that portfolio. But now the game has changed. It's not about growing anymore. It's about distributing without running out. So there's some rules for you retirees. Number 1, separate your money into time buckets. So bucket 1 is for near-term spending, anywhere between 1 to 2 years. You may want to consider having cash or cash equivalents in this bucket. Bucket number 2 is for intermediate needs, somewhere in that 3 to 10 year window. High-quality bonds fit very well in this bucket. In bucket number 3, and that's for long-term growth, we're talking 10 plus years. Stocks, bonds, real assets in this portfolio. Rule number 2, plan for your inflation rate, not the CPI. If healthcare costs is 20% of your spending, model 4.5% inflation of that cost. Don't anchor to 2.5% just because that's historical average. Number 3, build flexibility into your withdrawal strategy. Don't lock yourself into a fixed 4% rule. If in a bad market, cut the discretionary spending. And in good years, replenish cash reserves. Number 4, stress test against a 2000 to 2010 scenario. Can your plan survive 2 bear markets in 1 decade? If the answer is maybe, your plan needs more conservatism. Number 5, create tax flexibility. Don't have all your money in one tax bucket. Coordinate withdrawals across taxable, tax-deferred, and tax-free accounts. Use Roth conversions strategically in low-income years. If all your money is in one tax bucket, you don't have a retirement plan. You have a government partner making 25 to 40% of your decisions. So whether you're 35 or 65, the lesson of the last 25 years is this: uncertainty is the norm, not the exception. Hope is not a strategy, and your financial plan shouldn't require perfect conditions to work. Prices don't rise smoothly. Incomes don't grow predictably. Markets don't go up in straight lines. The economy experiences shocks. The question isn't what's the perfect plan. The question is, what plan works even if my assumptions are wrong? Your financial plan is like a car transmission. You need multiple gears. First gear gets you through the crash. Third gear keeps you ahead of inflation. Most people only have one gear. So first gear, think liquidity and safety. Cash, short-term bonds. This is for surviving downturns. Your second gear, income and stability. Think dividend stocks, real estate, longer-term bonds. This is for funding life without touching principal. And third gear, growth and inflation protection. Stocks, real asset, businesses. This is for staying ahead of inflation over decades. Most people only build one gear. They're either all in on growth or all in on safety. That's how you get stuck when the environment changes. You need all 3 gears, and you need to know when to shift. Okay, let me close with this. Most people spend their entire lives measuring their progress with the wrong tool. They look at account balances. They look at net worth statements. They look at dollar figures. But dollars are just the measuring stick. And as we've seen over the last 25 years, the measuring stick itself changes. 1 million in 2000 was real wealth. 1 million in 2025 was comfortable. But it's not the same. It doesn't buy the same house. It doesn't fund the same retirement. It doesn't educate the same number of kids. That number didn't change, but what it measures did. Wealth isn't what your statement says. It's what your money can actually do. And that's what's changed completely. So here's the real planning question you need to ask yourself. Am I measuring my wealth in dollars? Or am I measuring my ability to fund the life that I want? Because those are 2 different things. Wealth isn't what your statement says. It's what your money can actually do. And that's changed completely. So here's the real planning question you need to ask yourself. Am I measuring my wealth in dollars? Or am I measuring my ability to fund the life I want? Because those are 2 different things. You can have $3 million and still run out of money. Or you can have $1.5 million and never worry. The difference is the plan, not the number. If you're retired and you have $3 million, that's a number. But what matters is, can that $3 million sustain your healthcare, your housing, your lifestyle, and your legacy for 30 years in an environment where costs rise faster than the official CPI? If you're 40 and accumulating, the question is, am I saving enough to retire into a world where housing might cost 5 to 6 times my income, where healthcare inflation is persistent, and where college for my kids is a 6-figure liability? So here's my challenge to you. Go back and look at your plan, if you have one, and ask, does this plan assume smooth returns or steady inflation? Does this plan assume my income will always keep pace with costs? Does this plan account for the fact that my personal inflation rate is probably higher than CPI? If the answer to any of those questions is, I don't know, then you don't have a plan. You have a projection, and the projections are not plans. A projection tells you what happens if everything goes right. A plan tells you what to do when everything goes wrong. A plan is something that works when reality doesn't cooperate. A plan has liquidity for emergencies. A plan has flexibility for market downturns. A plan has growth for inflation protection. A plan has income for stability. A plan has been stress tested against back decades, recessions, and personal setbacks. If you're building that kind of plan, or if you want help building that kind of plan, well, that's what we do here at Asset Management Group. We don't just manage portfolios. We build plans that account for purchasing power, tax flexibility, economic volatility, and the fact that the measuring stick has changed and will keep changing. Because in the end, wealth is not a number. Wealth is the ability to fund the life you want with confidence and stability, no matter what the economy does, no matter what inflation does, and no matter what happens in the next 25 years. I'm Mo Paran with Asset Management Group. If this resonated with you, let's talk. Drop a comment below, like, subscribe, and share our channel. And thanks for watching, and I'll see you next time.